Welcome to Course 19 of the MaxLife Commercial Academy, Syndication and Raising Capital. I'm Ryan Solberg, real estate broker and founder of MaxLife Commercial here in Central Florida. In this course, we're going to break down exactly how syndicators raise millions of dollars from passive investors to acquire deals that no single person could fund alone. Whether you're an aspiring sponsor or a passive investor trying to understand the structure before you write a check, this course gives you the full picture, from securities law to partnership agreements to the waterfall that decides how profits get split. Let's get into it. So what exactly is a real estate syndication? At its core, it is a pooling structure. One person, called the sponsor or general partner, finds a deal, negotiates it, secures financing, and then goes out and raises the equity needed to close from a group of passive investors called limited partners. Those limited partners wire in their capital, take a fractional ownership stake in the entity that holds the property, and then sit back while the sponsor does the heavy lifting. Every month or every quarter, cash flow from the property gets distributed to investors based on their ownership percentage. And when the property is eventually sold or refinanced, the profit gets split according to a pre-agreed waterfall structure. The reason this model is so powerful is that it lets an operator with deal finding skills and relationships access nearly unlimited capital, and it lets investors deploy capital into institutional quality deals they never could have accessed on their own. That alignment of interest is what makes syndication the backbone of commercial real estate. Here at MaxLife Commercial, we work with sponsors and investors across Central Florida and beyond. And understanding this structure is foundational to everything else we will cover in this course. Now, here is where many new syndicators get into trouble. Securities law. When you raise money from investors in exchange for an ownership interest in a deal, you are issuing a security. Full stop. That means you are subject to federal securities law, and the primary exemption most syndicators rely on is Regulation D, filed under the Securities Act of 1933. Inside Reg D, there are two common exemptions you need to know, 506B and 506C. The 506B exemption is the traditional private placement. You cannot advertise publicly, no Facebook ads, no LinkedIn post pitching the deal, no webinars open to strangers, but you can accept up to 35 non-accredited investors who are financially sophisticated, plus an unlimited number of accredited investors. Accredited investors are individuals with a net worth over $1 million, excluding their primary residence, or income over $200,000 individually, or $300,000 with a spouse in each of the last 2 years. Under 506B, investors self-certify their accredited status, and you take them at their word. The 506C exemption flips this. You are allowed to publicly advertise and generally solicit investors, which is a game changer for building an investor pipeline online. But every single investor must be verified as accredited, not self-certified. You need third-party documentation, tax returns, brokerage statements, or a letter from their CPA or attorney. Both exemptions require you to file a Form D with the SEC within 15 days of your first capital close. I cannot stress this enough. Talk to a securities attorney before you launch any offering. This is not an area to wing it. Let's talk about how the entity is actually structured. Most syndications use a two-tier structure. At the top, you have the general partner entity, often a separate LLC owned by the sponsor or sponsors. Below that sits the deal entity, the LLC or limited partnership that actually holds title to the real estate. The GP entity is the manager of the deal entity, and limited partners buy membership interests in the deal entity. The GP has all the power. They sign the operating agreement, they sign the loan documents, they make decisions on capex, leasing, and ultimately the exit. That power comes with fiduciary obligations to the LPs. Limited partners, on the other hand, are purely passive. Their liability is capped at their invested capital. They cannot be sued personally for the property's debts, and they have no say in day-to-day decisions. They are essentially silent equity partners. Their rights are spelled out in the operating agreement. Things like the right to receive financial statements, the right to vote on major events like a sale, and the right to remove the GP for cause. The operating agreement is arguably the most important document in the syndication. It governs everything from how distributions are calculated to what happens if the GP wants to bring in a co-GP. If you are structuring a deal, invest in a securities attorney who specializes in real estate syndications to draft this document. It is not something you should download from the internet. The waterfall is the mechanism that determines how every dollar of profit flows out of the deal. Understanding it is critical whether you are a sponsor structuring the deal or an investor evaluating it. Here is how a typical waterfall works. First, investors get their capital back. No one makes money until the LPs are made whole on their equity contribution. Second, investors receive a preferred return, usually 6 to 8% annualized on their unreturned capital. Think of this as a priority dividend that accrues before the sponsor sees any upside. Third, and this is where it gets interesting, the sponsor often gets a catch-up. Once investors hit their preferred return, the GP receives 100% of distributions until they have caught up to their full promote percentage. For example, if the promote is 20%, the GP catches up until they have received 20 cents for every 80 cents the LPs received. After the catch up, profits split according to the negotiated tiers. A common structure is 70 to 30 in favor of LPs in the first profit tier, then shifting to 60 to 40 as the deal's IRR climbs above a higher hurdle rate like 15%. That second tier is the sponsor's real reward for finding and executing a home run deal. One critical point: never describe the preferred return as guaranteed. It is a priority, not a promise. If the deal does not generate sufficient cash flow, the preferred return accrues but does not get paid until the money is there. Always be transparent about this distinction with your investors and make sure your PPM reflects it accurately. A compliant syndication requires a stack of documents, and each one serves a specific legal or operational purpose. The most important is the Private Placement Memorandum, or PPM. This is your disclosure document. It tells investors exactly what they are buying, what the risks are, how you will use their money, what your track record is, and how the waterfall works. The PPM is primarily a liability shield for the sponsor. If a deal goes sideways and an investor claims they were misled, the PPM is your first line of defense, provided it accurately described the risks up front. PPMs are typically 50 to 100 pages long and are drafted by securities attorneys. Do not try to write one yourself. Below the PPM sits the operating agreement, which we covered earlier, and the subscription agreement, which is what each investor signs to formally subscribe for their interest. The investor questionnaire gathers the financial details needed to verify accredited status, and within 15 days of accepting your first investor dollar, you must file a Form D with the SEC through their Edgar system. Some states also require a separate blue sky notice filing, so confirm your state's requirements with your attorney. Finally, the pro forma and deal summary are not legal documents, but they are what your investors will actually read first. Make sure every number in your pro forma is consistent with what the PPM discloses. Inconsistencies create legal exposure. At MaxLife Commercial, you can reach us at 321-586-22121 if you have questions about the acquisition side of a syndicated deal. Raising capital is a sales process, but it is a sales process built entirely on trust and education, not pressure. Let me walk you through how this actually works in practice. Your very first investor dollar will almost certainly come from someone who already knows you. A college roommate who became a physician, a client from a previous deal, a parent who has extra capital sitting in a savings account earning nothing. Under 506B, that is your universe, people with whom you have a pre-existing substantive relationship. So the first thing you need to do, long before you have a deal under contract, is begin educating your network. Send a monthly email with what you are seeing in the market. Share a deal you analyzed and why it did or did not pencil. Post thoughtful content on LinkedIn if you want to build a broader 506C pipeline over time. When you finally bring a deal to your network, investors who have watched you think for 6 months will respond very differently than investors you are calling cold with a pitch deck. The second discipline is qualification. Not every accredited investor is the right fit for every deal. If someone needs liquidity in 2 years and you are buying a 5-year value add play, that is a mismatch that will create problems. Have honest conversations about what's investment horizon, risk tolerance, and how much illiquidity an investor can genuinely stomach. And when it comes to actually closing the raise, you do not need to have all your equity committed before you go hard on a deal. Many sponsors soft circle commitments from investors, get a verbal yes and a signed interest form, then open the formal subscription period once the deal is locked. Know your minimum raise to close, and structure your timeline around that number. Most courses on syndication spend all their time on raising capital and almost none on what comes after. But your long-term success as a syndicator depends almost entirely on what happens post-close. The day you fund is day one of your investor relations program. Within 24 hours of closing, send every investor a confirmation. Their capital has been deployed. Here is what the property looks like today. Here is the business plan. And here is when they will receive their first distribution. From that point forward, quarterly reporting is the minimum standard. Your investors want to see the rent roll, actual NOI versus pro forma, any variance and why it happened, and the status of capital reserves. If you told them they would receive a 7% preferred return and you are tracking behind it, tell them now, not at the annual meeting. The K1 is another non-negotiable. Your CPA needs to get K1s to every investor by March 15th so they can file their taxes. Missing this creates real friction and signals disorganization. The most important skill in investor relations is communicating bad news early. Every deal has problems. Roofs leak, tenants go dark, interest rate caps expire. The sponsors who lose investors forever are the ones who went quiet when things got hard. The sponsors who build a loyal investor base are the ones who called every LP personally when the roof needed replacing and explained exactly what it meant for distributions. Here at MaxLife Commercial, visit us at maxlifedevelopment.com/academy for more resources on structuring and closing commercial real estate deals. That wraps up Course 19, Syndication and Raising Capital. You now understand the full arc of a syndicated deal. the legal framework under Reg D, how to structure your GP and LP entities, how a waterfall distributes profits from first dollar to last, what documents you need in a compliant offering, how to build an investor pipeline before you need one, and why investor relations after close is the most underrated skill in this business. If you take one thing from this course, let it be this: syndication is a trust business. Your investors are handing you their capital with nothing but your word and your operating agreement as collateral. Honor that trust with transparency, consistency, and results. I'm Ryan Solberg, broker and founder of MaxLife Commercial here in Central Florida. My license number is 333-54351. If you have questions about finding and structuring your next commercial acquisition, give us a call at 321-586-2121 or visit maxlifedevelopment.com/academy to explore the full course library. Up next is Course 20, Data Centers and AI Campus Real Estate. I'll see you there.